Welcome back to Fast Market here on the Schwab Network. It's time for cash tags. For that, let's bring in Andy Swan, co-founder of LikeFolio. Welcome back to the show, Andy.
Happy Monday.
Happy Monday to you. On holdings, it had a great 2024, Andy. I think you guys were spot on as far as data goes, but we pulled back about 22% from those all-time highs that we saw at the end of January. This stock's getting hammered right now. Do you guys have any data that's reflective of that, or is it time that this might bounce?
Yeah, this has been a great stock to hold. We've been holders of it for quite a while and actually just closed our position a little bit into this pullback. It's one of those companies that came kind of out of nowhere. They have a really nice niche in the running footwear space. They built a great brand with incredible brand loyalty and people coming back time and time again to buy the shoes and to tell their friends about it. And so this has been a unbelievable growth story, and we think it's a phenomenal company. But at this point, we're just starting to see some of the tea leaves in the footwear business giving us a lot of pause. And the biggest of that was Deckers Outdoor last month. They put up, the ticker symbol there is DECK. They put up an awesome earnings report. Revenues up 17%, margins were up, increased forward guidance, and the stock sold down 17% on that report, which just tells me that the market is very much in a sell first, ask questions later phase, especially in the footwear space. And so we're concerned about on from here in terms of being able to maintain the stock price trajectory that it had. We think it's a fantastic company, just could be still a little overbought here. And we're a little bit cautious going into earnings just because of what we've seen. The destruction can be if you don't absolutely hit a grand slam, because again, Deckers Outdoor hit what I would consider a triple or a home run and still got sold off big time. So we've got some caution here. Another part of that caution is just that web visits are down year over year for the first time in the history of our tracking of this company. It's always been growth, growth, growth. And so we think that they'll come out with positive guidance, a good number, but they won't be able to absolutely hit it out of the park in terms of their overall outlook.
Yeah, Andy, the decelerating top-line growth is worrisome.
Yeah.
It might just be temporary. It might just be as they transition to, different shoe lines, but they're focusing on international growth. They're expanding their retail stores. Their direct-to-consumer channel is doing better. Their free cash flow is up, 18.8% free cash flow margins. So they're moving and expanding, but as you know, Andy, the market is a petulant child, and they want better, 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 always better. So that decelerating, once you throw the word decelerating in, they're going to take some valuation out of this name. But listen, in 1 month, down 17.4% is where I have it. That's a big haircut from where it was. Now, it looks like this company's still growing, just maybe not at the pace they were before. And frankly, Nike has rallied off its lows. Other shoes have done well. So the question is, in my opinion, everyone's wearing more gym shoes, Andy, than they've ever done before. So there may be an opportunity for just the pie to get bigger here. Your thoughts?
Yeah, no, I completely agree with that. I think that the market is growing. I get concerned when a company that's been very, its founding principles and the blood that is running through the heart of the company is about running and about, a very specific niche of a footwear market. And now they're expanding into apparel and into international markets and into just more, kind of everyday shoes. That always gives me pause, because I think it's just the rule of large numbers. It's the rule of a niche company trying to continue to grow at a pace that maybe isn't possible without expanding from the original niche that they're in. And there's always a large amount of risk that comes from that. I think, we used to talk about with you guys when Under Armour was moving from apparel into shoes, and the risks that they took there and the lumps that they took there were very significant. And so, Nike's been able to do it. historically, but that doesn't mean everybody else will be able to do it. And so with On Running, we're very impressed with the company's execution in its niche and its ability to grow, and we think it will continue to grow. We just have some concerns that, like you said, it just won't be up to Wall Street's what Wall Street has determined its new expectations are, is a very, very high bar of accelerating growth. And once any sign of the brake lights come on in this environment, it can be really nasty.
Yeah, the price to earnings on a trailing base about 106. On a forward-looking basis, still 46. So it's still expensive as far as valuation goes. You mentioned the growth numbers here, but PEG ratio is only 1. So that's pretty decent in this space because I believe as a sector, it's about a 1.2. So pretty good PEG ratio. But when you look at, the pullback that we've seen, Andy, does it give you a little bit more, ability to say, okay, if they can right the ship, or is this more about the consumer post-holiday shopping? They just stop spending as much as they did, and that might ramp up moving into the middle part of the year.
Yeah, I am concerned about that for sure. I also think that the pullback, maybe a little bit overdone, 17% in a month, or is it 20% in a month? Whatever it is, it's been a sharp pullback that has probably gotten the shares to priced about right. Going into earnings, we're just as neutral as you can be. We're in wait and see mode. We want to see what the company talks about in terms of its strategy. We can't wait to see what the company talks about in terms of outlook and the strength of the consumer. And then we can start to analyze from there. But, the niche growth story phase of this stock, we think is over. And now it's transition time. And a lot of companies fail at transition, but the ones that make it through to become a broader company and a broader demographic type of brand can have, another 5 to 10x up. It's very difficult to make that leap successfully. So we're going to be on the sidelines and watching and rooting for the company to do so. They've got a great executive team, but not with our money at this point.
All right. Neutral on holdings going into this report. Great stuff as always, Andy. Appreciate it.
Thank you.
All right. That's Andy.